Okay, so welcome to this training about what are trading traps, and I'm going to talk to you today about the three major core disciplines behind trading traps that we look to exploit every day in the financial markets. There are obviously unlimited amounts of trading strategies out there, and what we're trying to do is we're trying to hack their strategies to use them against our opponents effectively. Now that might sound like a task that is just too big to try and understand and fathom, but the reality is, fortunately for us, there's not too many major core disciplines. In fact, there are three. We're going to talk about them right now. So number one, we have breakout trading. Okay. Number two, we've got retracement trading. Okay, or pullbacks. And three, we've got level trading. Okay, so basically, irrespective of what type of trader you are or what type of trading that you're involved in, the bottom line is you're usually one of these three major core disciplines. And what's so fantastic about that is what that does is that allows us to hack these strategies with relative ease. It's not difficult to see traders in this way. So what we want to do is we want to take on board their behavior. And by and large, if you've been trading a while, you'll know this to be true, that you've probably done some level trading before. You've probably tried, some retracement trading at some point, some type of trading of support and resistance. If you're new, get yourself along to Baby Pips or YouTube. There's plenty of free information out there online about how you trade support and resistance, retracements, breakouts, etc. And what I want you to do is learn to spot these setups, but at the point of entry, I want you to hold fire and not take those trades. I'm just going to talk to you about why we believe it's very important to look at the markets in this way. And what I'm going to explain to you now is the reason why we do this is because it's my view, my opinion, that the market acts as one big giant trapping mechanism. Okay, now it starts with a candlestick or any type of representation of price. And here we've got a candlestick and it's a bullish candlestick. Okay, so it's heading up. Now, basically, what a lot of people don't realize is that quite often when the shadow or the wick of the candle is being created, what people don't realize is that that once was heading in the opposite direction. So when you look at the candle and you just see it's gone up and you consider that to be bullish, what you fail usually to understand was that this had looked negative at some point in its life from the open of the candle. So you got the open, you've got the high, you got the low, and you've got the close. From the open, it'll back and fill, and ultimately head in one direction or another. But usually if it just does that straight from the open, it's a bit of an optical illusion, if you will. It looks negative because it's red, it's negative, whatever color you use to represent a negative candle. For me, it's a red candle. It starts going down and you see red and you think that that's bearish and price is going to continue lower. But what happens often is that from that opening price will, whatever direction it starts off from the open, what tends to happen, it'll go a certain amount of direction and then it will flip back to the opening price before it starts to head up and ultimately close bullish like that. So what just went on there? This is why I refer to the financial markets as being traps, just one big giant optical illusion, one big giant trapping mechanism. And that's because if you had been in this trade or witnessing this trade, at least witnessing it, you would have seen it negative at some point in its life, but it didn't finish negative, it finished positive. Now, if you actually took that trade to the downside, imagine that this was occurring off a level of resistance, let's say. This was happening off a level of resistance, and this was perhaps an entry for you. You would have looked at that and gone, bingo, this is my analysis is correct. The market's showing me that it's at least trying to do what I think it's going to do. Boom, you go short, and then it flips. And then ultimately what that's doing is it's trapping you, the trader. You're trapped. And price is up in here, and it closes positive. There's no denying that if you're still in that trade down in here, you are definitely trapped as the market is up in that area there, right? You definitely feel trapped. There's no getting away from the fights, you're losing money, end of story. So the candlesticks themselves are acting as traps. The next part to it, I believe, is how the information is actually presented to us on a chart. So it's very much about, when traders are taking a trade, it's very much about that historical analysis. Let me give you an example. If you've got a level of what you may believe to be a level of support, and prices come down to it, bounced off it once, comes back twice, so it's a double bottom at this point, comes back into the level. This is a third time, triple bottom. This is very much a buying signal for many traders, right? If you're a level trader. Now here's the thing. We do that historical analysis based on those patterns, and we think that perhaps this is a trade that's worth a go. Now, what's really interesting is that we have this thing on all of our charts to the right-hand side, which is known as the hard right edge, HRE. Okay, and what that is it's basically this big void that we've all got to the side of our charts, and it's ultimately going to fill with price. It just needs a little bit of time to elapse. But what happens is, because we're focusing on this historical analysis, they don't pay too much attention as to what's going to happen in the future. And then the final element to that is that they are focusing on the price as it starts to print at the hard right edge. So it starts to actually starts to go up as it had done here, and as it had done here, and this had made people money, right? It looks as if it's working, and that's the trick. So at the hard right edge, people see price bouncing off that level as it had done historically. They don't pay any attention to that, to the fact that there's this big void that's going to fill. We just need a little bit of time to pass. And then the coup de grace, if you like, is that the price action in the here and now as it's printing, what I refer to as entry cheese, is the price action that's tempting the trader in off the sidelines to make them basically accept that their analysis was correct, and now it's time to actually pull the trigger and jump into the market. All of that serves as a trapping mechanism because it makes them believe that what they are seeing is actually going to play out. But of course, no sooner do they enter the market, price starts going against them, and it traps those traders on the wrong side of the market. So the trap was set, and all of those elements come together to make it so that these traders get caught. Now let's just take a look at that in a little bit more detail. Bit of a closer up example. So here's your second touch, comes back into the level, here's our hard right edge, and price starts to react off the level. Now that's reacting in pretty much the same way. It's not always precise, but it's very, very close. The process is always the same though. It may aesthetically look slightly different, but the process is always the same. As it did do here when traders actually went in and they made some money across that range. So when you sat here in the early part of that trade and it starts bouncing off the level where you believe this to be, you know, a double, triple bottom or whatever, where people are going to go long, this convinces you to take some risk because you believe that the market is at least trying to do what you thought it was attempting to do in the beginning. So you take the trade, you go long, but then the market starts going against you. And interestingly, a very typical place for traders to place their stop losses in an example like this is just under this level. Okay, traders will place the stops just under these levels, and then as price starts going against them, this is where they'll start having that conversation with themselves to cancel the stops. And then obviously the more that goes on, the more trouble they're in. They get stuck. So we know something about traders in this area who took that trade. They're essentially trapped, and that's what we're looking to take advantage of.